going to learn accounting standard 20. Earning per share. What is an earning per share? Earning per share (EPS) is the portion of company's net profit attributable to shares. In simple terms, earning per share shows the profit earned by the company from each share held by the shareholders. This can be used by the investors to compare performance across companies. Objectives of earning per share. The main objective of AS20 is to prescribe principles for calculation and presentation of earning per share in financial statements. Also, earning per share indicates the profit earned per equity share, which will help the investors to make informed decisions about the profitability and valuation of companies. AS20 is applicable to all listed companies and companies that are in the process of listing. Also, they are applicable to companies with potential derivative instruments, for example, convertible debentures, stock options, price shares, etc. Types of earning per share. There are two types of earning per share: basic earning per share and diluted earning per share. Basic earning per share is a simple calculation where the company's net income is divided by the total number of outstanding common shares, while diluted earning per share is a conservative metric which includes all potentially diluted securities such as convertible debentures, stock options that could be converted into more shares. Study how to calculate basic earnings per share. Here is the formula. Basic earnings per share is equal to net profit or loss after preferred dividend divided by weighted average number of equity shares outstanding. The net profit should be after deducting preference dividend, and the weighted average number of shares account for the changes in share capital during the period. Study how to calculate basic earnings per share. Here we can see that the formula is equal to net profit or loss after preference dividend divided by weighted average number of equity shares outstanding. That is WANS. WANS. So, if shares are issued during the year, include them the date of issue. So, in case of new issues, WANS is equal to shares outstanding before issue into a fraction of year plus new shares into fraction of after issue. If in the case of buyback of shares, the WANS is calculated using the equation shares outstanding before buyback into fraction of year plus remaining shares into fraction of after buyback. In the case of bonus or back shares are issued, the bonus issue is treated as at the beginning of the year for all the period presented, and in the case of right issues, adjusted for the bonus element, that is shares issued without additional consideration. So, let's study how to calculate diluted earnings per share. Here we can see that the formula is adjusted net profit divided by adjusted weighted average number of shares. Okay, so how to calculate adjusted net profit? Start with the net profit after tax for the period, then add back the interest or dividends on dilutive instruments. For example, convertible debentures, add back interest net of tax. If in the case of convertible preference shares, add back dividend net of tax. Formula is simplified. Adjusted net profit is equal to net profit plus interest into 1 minus tax plus preference dividend plus other adjustments due to potential conversion. In case of adjusted number of shares, includes shares issued due to conversion or options. So let's discuss a problem. The question is, Rahul Limited Company has following the information. Net profit is equal to 28 lakhs. Preference dividend is equal to 3 lakhs. Number of equity shares on 1st January is equal to 2 lakhs. And on 1st July it's 1 lakh. Convertible debentures is equal to rupees 5 lakhs at 10% interest per annum. Convertible into 50,000 shares and the tax rate is 30%. Let's calculate basic earnings per share. The equation for basic earnings per share is equal to net profit or loss after preference dividend divided by weighted average number of equity shares outstanding. So let's calculate WANS. Here, the shares outstanding before issue is equal to 2 lakhs and fraction of year is 6 by 12 since it's January to June, and new shares is 3 lakhs and fraction of year after issue is 6 by 12. WANS is equal to 1 lakh plus 1 lakh 50,000, that is 2 lakh 50,000. In case of net profit after preference dividend is equal to 28 lakhs minus 3 lakhs, that is 25 lakhs. Basic earnings per share is equal to 25 lakhs divided by 2 lakh 50,000, that is rupees 10 per each share. So let's see how to calculate diluted earnings per share. The equation for diluted earnings per share is equal to adjusted net profit divided by adjusted weighted average number of shares. Adjusted net profit. Here we can see that net profit is equal to 25 5 lakhs into 10% that is 50,000 into 1 minus 0.3 that is tax rate minus 1. So the answer is 25 lakhs 35,000. Then adjusted number of shares include shares issued due to the conversion or options that is 3 lakhs. So diluted earnings per share is equal to 28 lakhs 35,000 divided by 3 lakhs that is rupees 8.45 per share.
In today's class, we're going to see the concept provision under AS29. Before getting into the concept, let us go with an introduction. Accounting Standard or AS. In AS29, it was issued by the Institute of Chartered Accounts of India (ICAI), which deals with the recognition, measurement, and disclosure of provision. Also, contingent liability and a contingent asset. This standard aims to ensure that financial statements present a fair and true view of an entity's financial position concerning their uncertain items. Now let's see the definition of provision under AS29. It is clearly mentioned that a provision is a liability which can be measured only by using a sustainable degree of estimation. The key characteristics distinguishing a provision from other liability like trade payables or accruals is the uncertainty regarding the timing or amount of the future expenditure prepared for settlement, necessity significant and estimation. Next topic is criteria for provision recognition. A provision must be recognized only when all three of the following conditions are met. The three of the conditions are: first one, the present obligation for past year; the second one, probable outflow of resources; at last one, reliable estimate possible. Let's see one by one. What is meant by present obligation as a result of a past event? The enterprise's asset obligation may be legal or constructive at a balance sheet date as a result of past obligation event. An obligation is the event that creates the obligation that results in the enterprises have no realistic alternative but to settle the obligation. The second condition, probable outflow of resources. It is a probable, meaning more likely than not, that an outflow of resources embodying economic benefit will be required to settle that obligation. The third condition, reliable estimate possible. The use of estimate is an essential part of financial statement preparation and it does not underdetermine reliability. Even for provision which are inherently certain, yet what you have to see is, if any of these three conditions is not met, a provision should not be recognized. If the first condition is met but either the second or third is not met, the matter is generally disclosed as contingent liability unless the probability of outflow is removed. Next topic is measuring the provision. The amount recognized as a provision should be the best estimate of the expenditure required to settle the present obligation at the balance sheet date. The first one is best estimate. This is the amount that an enterprise would rationally pay to the settled obligation at the balance sheet date. The next one is risk and uncertainty. Must be factored in. The second one is risk and uncertainties. Risk and uncertainties surrounding the future expenditure should be taken into the account. For instance, if a range of outcome is possible and each point in the range is equally likely, the middle point of the range is generally used. The last one is future event. Future event that may be arise, a chance to affect the amount required to settle the obligation. Next concept is disclosure requirements. For each class of provision, enterprises should disclose nature and timing, carrying amounts, movements, uncertainties, and last reimbursements. The first one is nature and timing. A brief description of nature of the obligation and expected timing of any resulting outflow of economic nature. The next one is carrying amounts. The carrying amounts at the beginning and at the end of the period. Additional provision made during the period are to be considered. The next one is movements. Amount used, incurred and charged against provision during the particular period. The fourth one is uncertainties. An indication of uncertainties about the amount of timing are those outflow what is necessary. The last one is reimbursement. The amount of any expected reimbursement, stating the amount of any asset that has been recognized for the expected reimbursement.
Okay, so here for the next topic, contingent assets. AS29 covers the accounting treatment and the disclosure of contingent assets, ensuring clarity and reliability in financial reporting. A contingent asset is a possible asset that arises from the past events, the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the enterprise. So, defining contingent assets. possible assets. A contingent asset is a possible asset arising from past events, and the uncertain confirmation its existence is confirmed only by the occurrence or non-occurrence of one or more uncertain future events. The external control. These future events are not only within the control of the enterprise. The practical example employed pursued through the legal proceedings where the outcome is uncertain and depends on the future court decision. And the next example is the compensation claims of damages or insurance recoveries awaiting acceptance by the insurance. So, we are going to the next session. Recognition and prudence principle. S29 adopts a conservative approach to prevent the anticipation of income that may never be realized. The first one is initial status. Initial status is the contingent assets are not recognized in financial statement. And the second one is underlying reasons. Underlying the reasons is based on the principle of prudence, avoiding the anticipation of uncertain income. And the third point is recognition threshold. So this means by recognize the asset only where the inflow of economic benefit becomes virtually uncertain. Realization becomes virtually certain. Asset is no longer contingent and must be recognized as an asset in the financial statement. Defining contingent asset. The first point is possible asset, the second point is uncertain confirmation, and third point is external control. A possible asset is a contingent asset, is a possible asset arising from past events. The uncertain confirmation existence is confirmed by only the occurrence or non-occurrence of one or more uncertain future events. The external control is that these future events are not only within the control of the enterprise. Here are the practical example. A client pursued through legal proceeding where the outcome is uncertain and depends on the future court decision. And the second point is compensation claims for damages or insurance recoveries awaiting acceptance by the insurance and prudence principle. So this principle is 29 adopts a conservative approach to prevent the anticipation of that may never be realized. And not recognize the S29 prohibits the recognition of contingent asset in financial statement until the realization of income is virtually uncertain. The first point is initial status, and second point is underlying reason, third point is recognition threshold. A initial status is meant by a contingent assets are not recognized in the financial statement. Underlying reason means this is based on the principle of prudence, avoiding the anticipation of uncertain income. And the third point is mean by recognize the asset only when the inflow of economic benefits become virtually uncertain. Disclosure and assessment. Financial statement disclosure. No disclosure required. AS29 generally does not require disclosure of contingent asset in the financial statement. Even when an inflow of benefit is probable, management report. When the inflow of economic benefit is probable, disclosure may be made report of the approving authority, such as the board of directors, rather than the financial statement themselves. And the second point is automatic disclosure. If the inflow of economic benefit is probable, disclosure may be made in the management report. Example, board directors report. And third one is do not recognize. Never recognize until the realization of mutual certainty. Recognize and disclose. If inflow becomes mutually certain, recognize the asset disclosure appropriately. A periodic assessment is a continually assess the contingent asset for the changes in the circumstances.
Next topic, accounting standard 29, contingent liability. Contingents can be classified into two, contingent asset and contingent liability. First, we can see liability. What do you mean by liability? It represents the present obligation arising from the past event, the settlement of which is expected to the result in outflow of economic resources. Example, loan. Present obligation means immediate obligation. What do you mean by contingent liability? Contingent liability is a potential future obligation that may arise depending on the outcome of an uncertain event, such as pending lawsuit or a product value. It is not a current liability because its existence is conditional on a future event. That means
that may occur depending on the future outcome. Next one, key characteristics. First one, uncertainty. A contingent liability existence and amount are uncertain because they depends on a certain future event. Next one, conditional obligation. The obligation become a reality only if the triggering event occur. Example, lawsuit. Next topic, accounting treatment of contingent liability. First one, probable and estimated. If the probability of the future event is high and the amount can be reasonably estimated, the company must be recorded the liability of its balance sheet and recognized and expense on its income statement. Next one, possible but not probable. If the event is only possible and not probable, or if the amount cannot be reasonably estimated, the company does not record a liability but must disclose the contingent liability in the notes to the financial statement. Next one, remote. If the probability of the event is remote, no disclosure of recording is necessary. Remote is not recorded in the financial statement and not disclosure in the financial statement. Let's discuss a problem. A manufacturer offers a 1-year warranty on a new line of electronic device for each unit sold. They must be accounted for potential future repair or replacement cost. The company's historical data shows that 30% of the units sold will have a warranty claim. During the first year, the company sells 1000 units at $500 each. The average repair cost per defective unit is estimated to be $75. Since the historical data indicates that 3% of the units will fail, the company determined that a warranty claim is probable future events for the products line as a whole. Estimated the cost. The company can reliably estimate the total cost. Total estimated warranty expense $75 per unit into 1000 unit into 3% is equal to $2,250. Accounting treatment. Because the event is probable and the cost can be reliably estimated, the company must recognize a provision for the warranty liability on its balance sheet. An entry will be debit the warranty expense account, credit the warranty liability.